Smith was aware of this, credit to him. He said, people of the same trade seldom meet together, even for merriment and diversion. I don't think he's talking about us. But the conversation ends in a conspiracy against the public or in some contrivance to raise prices. That's page 207. So he recognized this. And so markets often fail to produce efficient and desirable outcomes, and you end up with externalities. One party's action can have a large negative or positive effect on others. Welcome, Professor Pollard. Empirical evidence from several countries. The bubbles, a good example. The dot-com bubble actually occurred because there was so much of freedom, and there was a lot of risk taken, a lot of risk that was being taken, ended up with the dot-com bubble. If you have time, try and read that. You can pick that up on the internet. It's the same with the 2008 financial crisis. So deregulation created instability, especially in the financial sector. So, and it added in this case with the dot-com bubble. And the market failures, the many examples of market failures are caused by, of course, the law of economic supply and demand, but also by government. And this is a very interesting book. If you have time, I suggest you have a look at it. It's by Joseph Stiglitz. It's a 2012 publication. It's called The Price of Inequality. And this is what he says. He says, in a modern economy, government sets and enforces the rules of the game. What is fair competition? And what actions are deemed anti-competitive and illegal? Government also gives away resources, both openly and less transparently, and through taxes and social expenditures, modifies the distribution of income that emerges from market, shaped as it is by technology and politics. So there is a section in the book that discusses this. So what am I going to talk about today? So we're going to look at the links between the state, politicians, and the corporate sector. So I'm moving the focus to the corporate sector. We're going to focus and look at the firms that are listed. How are rules of the game set and enforced by firms, for firms by the governments? How does the government treat these corporations? And this area of research has been called, they refer to it as corporate political activity. So you can see that essentially it's about state, government, politicians interacting with corporation, how the corporations influence government through lobbying and donations. So it's a very complex area with a lot of opportunities for research, not just in some countries, but in many, many countries. Corporate political activity, and now the term political embeddedness has been used to describe the relationship between government and the corporate sector. And it is used to explain firm performance in the political arena. So political embeddedness is the bureaucratic, instrumental, or effective ties to the state and its actors. So this implies there are both formal and informal ties to the politicians or the state, formal and informal. And the embeddedness perspective will view and conceptualize inter-organizational government relationships as associated with norms, expectations, and responsibilities rather than arm's length transaction. Rajan and Singalas 10 years ago identified what they call relationship-based systems. And in relationship-based systems, the deals are not arm's length. They are all based on you know me and I know you, and what is it in it for me. And even in China, people talk about guangxi, which is actually a form of, excuse me, a form of the relationship-based system. And business transactions happen in specific social, cultural, and political context. So it makes a lot of sense to see that the embeddedness perspective is a way, is a practical and useful way of trying to understand this relationship. But to unravel the intricacies and the different relationships between business, politicians, government, ministers, and the corporate sector is very difficult. So that's why it is a challenge for academics who want to try and understand the relationship. Now, of course, the inter-organizational relationships will facilitate business transaction, but at a cost because it will constrain business activity. And the term that's used is over-embeddedness, can cause governments to control the board. At a cost, government interests may not converge with the firm interests. When you say firm, it means the shareholders. Now, there are three reasons why corporations are involved in politics. There are different interpretations, but I picked up Basinger's interpretation because it's quite straightforward. Basinger identifies three reasons, one of which is domain management. So domain management refers to the idea that firms want to gain subsidies, they want to get government contracts, and want to obtain some anti-competitive favors. So that's domain management. Domain defense, firms use politics to manage public policies that might be at odds with the firm's own goal. Good example would be the legitimacy of tobacco firms due to the adverse impact of tobacco. So the tobacco companies lobby, and to the extent of providing political contributions, favors, and so on, to obtain legislation that does not go against their marketing strategies. The firm is involved in politics to counteract such changes. Domain maintenance, this one is the means to influence public policies that might threaten the means by which the firm achieves the goals or the legitimacy of the firm's methods. The argument that the pursuit of competitive advantage through political means can insulate firms from competition is ethically problematic. It effectively condones unethical and sociopathic behavior. So the argument, part of its strategy is to obtain political favors, so we need to lobby, we need to give contributions so that we can achieve our strategic objectives, in my mind and in the papers that I've read, is ethically problematic because it does condone what we call unethical and sociopathic behavior. Business-government links has changed the corporate landscape in the last 20 to 30 years. You have state-level capitalism, where state level means the government is involved in firms. You have it in China, the Gulf states, Africa, Nigeria, and of course at home here in Malaysia. Weak or incomplete institutionalizations lead to the development of potentially corrupt political engagement by firms. So there you go. In Malaysia we say under the table, but this is pretty obvious. Okay. Now, what are the characteristics of this rent-seeking, this corporate political activity? Two main characteristics may be identified. What we economists call rent-seeking, and the other is government munificence and distortionary subsidiaries. Now, rent-seeking, you help the rich at the expense of the rest. Politically connected firms would be better at this. Have a look at that. There you go. Rich obtain resources at favorable terms. And of course, I've mentioned the negative sum games. Good example would be the Russian oligarchs. They obtain wealth, particularly the oil wealth, by buying state assets at below market prices. And of course, selling to government at above market prices, non-competitive procurement, and drug companies, typical of drug companies and military contractors. And then you have oil and mining companies. They get contracts to oil and mineral resources at below market prices. And some rent-seeking activity destroys or distorts the economy. I use the word some. If it's as a result of monopoly, then it's most likely to be distortion. But not all rents are bad. If it's Schumpeterian rents, rents in terms of innovation. So an innovating entrepreneur, if he earns more money, then the higher return is justified. Now, the idea of rents, perhaps I should have mentioned this idea, originated, and mentioned this earlier, originated actually the French physiocrats. They talked about rent for land. But over the years, what it really means is that you're obtaining something that is beyond what is called in economics normal profits. So it's more than what you should earn. Now, government munificence and distortionary subsidiaries, this is well known. Government purchases from link companies and they pay prices well above costs. Now, this is a big problem because it's inefficient, particularly if it's the use of taxpayers' money. One link company bailing out another company when that company should have been sold off as a bankrupt firm, but it's bailed out, so inefficiencies can survive. Protect linked firms from foreign competition. There are many ways of doing that. Taxes, selective taxes, tariffs, and so on. And there you go. And these tariffs protect inefficient, old, tired industries. So these are some of the problems that introduce inefficiencies. Now, corporate political activity is not something that is inherent in just the emerging countries, but it's also developed countries. And let me just take you through some of these ideas. In the US, recently you have the milestone case in corporate political activity. It's Citizen United versus Federal Election Commission, 2011. It actually ended 65 years of the Taft-Hartley Act, which bars corporations and unions from using general treasury funds to finance political campaign and advertisements. Now, corporations under this act can support candidates in election. Of course, it's based on the First Amendment. So firms influence government through campaign contributions, direct lobbying, government membership on boards, bribery, and so on. In the US alone, just as an example, there were 3,160 lobbyists working for the health industry, 2,000 for energy and natural resources. But look at the figure. It's $3.2 billion spent on lobbying. And to what extent the decisions that are made by these politicians would contribute to the efficiency of the firm, we don't know. Or for that matter, you can extrapolate that from firm level to the economy. So this could be quite a serious problem. Here you go. Even our local Petronas is hiring lobbyists. This is from the Star newspaper. So if you accept this article as true, then this is the information. Petronas is Petroleum National Berhad is hired lobbyists to help it secure approval from the Canadian government for the $5.2 billion takeover of Progress Energy Resources. So this is quite a common way of trying to obtain, obtaining business and taking over other companies. Now, this is an interesting paper. Excuse me. Now, this paper is published in Journal of Finance. So those of you in the finance area know that this is the A triple star journal. And it's just published in 2010. This paper looks at corporate political contribution and stock returns in the US. Now, stock return is a good measure of how well a company is doing, simply because if the market is liquid and shares are being actively traded, and if the share prices go up, it is a good indication of how the market views the company. Now, they looked at political campaigns from 1979 to 2004. They construct variables that measure the extent of firms' support for political candidates. They find that these measures are positively and significantly correlated with the cross-section of future returns. The more money you spend on political contributions, the higher your stock returns. And the results, the relationship is even stronger for firms whose contributions are slanted towards House candidates and Democrats. So it looks like the Democrats are willing to put their hands under the table. Now, look at this figure. This is just taken off the paper, but it's quite a complicated figure. All he's talking about is contributions to Democrats, contributions to Republicans. And this, of course, there's individuals, labor, and this is corporate sector. But the corporate sector, you can see, is quite a significant amount. And there, corporate sector. So the corporate sector is involved in contributions, political contributions. And it seems to pay off in the US. And this is an area, again, that needs a little bit more research to try and understand the channels of how this happens. Is the market saying, you have contributed to this politician or a group of politicians, we think this is a good thing? Or is it through some other channel? We don't know. This is, again, an area that is crying for some research. Another one that's interesting is corporate lobbying and fraud detection, another 8-star journal, Journal of Financial and Quantitative Analysis. It examines the relationship between corporate lobbying and fraud detection. And corporate lobbying is the firm's business strategy, culture, ethics, and the point is that the question that they're trying to unravel is whether corporate lobbying makes fraud more difficult to uncover. And they use a large sample of large frauds in the US, historical data, archival data. And this is after the Private Securities Reform Act, which actually made it more difficult. So firms that lobby have a significantly lower hazard rate of being detected for fraud. And fraudulent firms on average spend 77% more lobbying than non-fraudulent firms. Now I must emphasize that there's a lot of statistics in this paper. They use regression, and the methods they use is very tight. And of course, you have, with the top journals, you have rigorous reviewing process. So the results are very credible. And so we can conclude that clearly it pays to lobby. And it looks like there is an implication here, of course, that firms that lobby are the ones that are doing some shady business because they finally end up being detected for fraud. But except that, it takes longer. Rentseeking, emerging countries, government, I mentioned government munificence. Problem is most acute in countries with excellent natural resources. This seems to be the tendency. I mentioned to you rent-seeking, corruption, and this government munificence where they provide contracts, they provide opportunities for politically connected firms, particularly countries with natural resources. South Africa and Nigeria are the, actually I'm also going to talk about China. South Africa was a successful country in Africa, and many of you will remember the days of Nelson Mandela. 1994, democracy was introduced into social institutions. Parliament and electoral systems, there were independent courts, strong stock market, full of minerals, and it was, the South African economy was a very robust economy. Today, there you go, under the leadership of Zuma. It didn't take long. It's been described by the economists as a hopeless continent, sliding, well, these are what the economists said, okay, sliding politically and economically. 2% growth, there's a downgrade of the South African sovereign debt, poor education levels, and the World Economic Forum identifies it as 132 out of 144 in terms of education levels. Inequality has grown. Economists will know Gini coefficient. 1993 was 0.59, and 18 years later it was a mere 0.63. The culprit, according to the economists, ANC, corruption, contracts to cronies, and rent-seeking activities. So this is South Africa. Nigeria, good luck, Jonathan. He probably needs some luck anyway. Information about Africa's biggest oil industry is opaque, myriad of numbers. This is straight from page 42 of The Economist. And fraud amounting to 6.8 million over subsidy for petrol imports, and the involvement of fraudulent politicians. The state-run behemoth NNPC, Nigerian National Petroleum Corporation, has been identified as the world's most closed oil company. Transparency, NNPC is a slush fund for the government. Oil wealth has disappeared. More than half the population of Nigeria, 160 million, survive on $2 a day. Now that is really abject poverty. So, country with so much of wealth, oil wealth, so much of resources, yet the economic development, if you define it broadly, has some equality in income, higher standards of living, better health facilities, lower levels of corruption, is absent. China. I have an interest in China, but I'm not going to talk very much about China. China, of course, this is just a few days ago, November 21st, or yesterday actually. This was in the Financial Times. And scandals, the title is Scandals Fail to Dent Faith in China's State-Led Capitalism. The article basically says that you have the government and you have members of the state-owned enterprise. They are very bullish and they feel that all the state-owned enterprises and all those with political connections to the Communist Party are doing very well. In fact, they claim the credit that China's spectacular economic development and economic growth is because of the state-owned enterprises. It's true to some extent, but here are some of the facts. State-owned enterprises are less efficient than private companies. The data shows that the private companies are 10 percentage points higher in terms of their efficiency. The state-owned enterprises are the center of China's, just an example of the melamine lace scandal. The high-speed rail crashed, killed 40 people. That's a state-owned enterprise. And there is a recent book that you might want to look at. It's by James McGregor, and in the book entitled No Ancient Wisdom, No Followers, The Challenges of Chinese Authoritarian Capitalism, argues that the Chinese model is nearing its sell-by date. So what that means is that, that there should be some changes. Okay, now coming closer to home, I've sort of taken you on a journey and given you snippets of different aspects of corporate political activity, different countries. But the issue that is interesting for scientists like us is what is the scientific evidence regarding links between corporate political activity and firm-level outcomes? There are so many different firm-level outcomes. We just focus on some corporate finance issues and also some accounting issues. Now, one of the earlier papers, not really, it's a recent paper, I'm sorry, Journal of Corporate Finance. This paper looks at, again, cross-country data from, like my paper, the earlier paper on Journal of Empirical Finance, and tries to see if there's a link between firms that are politically connected and the cost of equity capital. Now, the cost of equity capital is very important because it's the cost of raising financing, raising funds for the management of your firm. Some people distinguish between the cost of equity capital and the cost of debt. I will look at the cost of debt in a while. So this paper examines the equity capital of politically connected firms. And those are the countries they look at. And you can see that they look at a number of firms and covers quite a number of countries here and includes the US. And the results, what do they show? They show that politically connected firms enjoy a lower cost of capital than their unconnected firms, than their non-connected firms. So it looks like this is positive news. But remember, this is firm level, and it's only talking about the corporate sector. It could be that when investors are looking at a company, they realize that this company is unlikely to go bankrupt. Why? Because the company could easily obtain bank loans. It can be bailed out. It has the backing of politicians or the government. And therefore, investors feel that political connections are more valuable for firms with stronger political ties. They also find in this paper that the relationship is stronger for countries with less press freedom. I think we can understand that. Less democracy, higher corruption, and limited market development. But the crux of this paper is politically connected firms do have some positive value added. This is another paper that looks at whether quality of accounting information is affected by politically connected firms. The issue here is whether politically connected firms are associated with lower quality earnings. And one of the standard ways of measuring quality earnings is to use variations of accruals. And accruals are those items which managers can manipulate, either positively or negatively, And so accruals has been a very popular way of managing earnings. And it's an interesting area. And in the first year itself, when students have to do adjustment, they have to look at accruals. So it's quite interesting when you tell the students, hey, this is one way of manipulating earnings, and they suddenly get interested. Connected firms are more opaque.